the Fed's next move could silently cost you $4,200 a year. Inflation is rising, and the Bank of America CEO is warning that it will back the Fed into a corner, leading to higher interest rates and decreased purchasing power. You'll learn how to mitigate these effects and protect your finances. The current inflation rate is 6.5%, which means that the $100 you had last year can only buy $93.50 worth of goods and services today. And if inflation continues to rise, that number could drop to $85 or lower. For example, if you're living in New York City, where the cost of living is already high, inflation could cost you an additional $2,000 to $3,000 per year. But it's not all bad news. There are strategies to mitigate these effects, such as investing in assets that historically perform well during periods of inflation, like real estate or commodities. For instance, if you had invested $10,000 in gold last year, it would be worth around $11,500 today. Additionally, back in 2010, when inflation was around 1.5%, the price of gold was around $1,100 per ounce. Fast forward to today, with inflation at 6.5%, the price of gold has risen to around $1,700 per ounce. This demonstrates how inflation can impact the value of certain assets. Moreover, a second-order effect of inflation is that it can lead to higher prices for everyday items, such as food and housing, which can have a significant impact on low-income households. But the part that surprised me most is what this does to your savings account. That's next. But the part that surprised me most is what this does to your savings account, and the numbers are staggering. For instance, if you have $10,000 in a savings account earning 2% interest, inflation could reduce its purchasing power by $650 over the next year, equivalent to a 6.5% decline. That's what we'll explore next, along with strategies to protect your savings from the erosive effects of inflation. And you'll be surprised to learn how a simple adjustment to your savings strategy can make a big difference in the long run. Higher interest rates can make borrowing more expensive, which could lead to decreased consumer spending and economic growth. For example, if you have a credit card with a balance of $5,000 and an interest rate of 18%, your monthly payment could increase by $50 to $100 if the interest rate rises by 2%. But it's not all bad news. Higher interest rates can also mean higher returns on savings accounts and certificates of deposit. For instance, if you had $10,000 in a savings account earning 2% interest, you could earn an additional $200 per year if the interest rate rises to 4%. Back in 2008, during the financial crisis, interest rates were near zero, and the economy was in a recession. However, when interest rates rose in the following years, the economy began to recover, and borrowing became more expensive. Additionally, a common misconception is that higher interest rates always lead to decreased borrowing, but this is not entirely true. In some cases, higher interest rates can lead to increased borrowing, as consumers may be more likely to take out loans to invest in assets that appreciate in value over time, such as real estate. Today, with the current inflation rate and rising interest rates, it's essential to be aware of the potential impact on your borrowing costs. But what about the impact on the housing market? That's what we'll explore next, including a surprising example of how higher interest rates affected the housing market in the past. But what about the impact on the housing market? And how will it affect your ability to buy or sell a home? The answer might surprise you, as higher interest rates could lead to decreased demand and lower housing prices in some areas. On the other hand, some regions might see increased demand due to lower prices and lower cost of living. For example, if you're considering moving to a city like Chicago, where the median home price is around $270,000, you might find a good deal on a home. We'll dive into the specifics of how inflation and higher interest rates will impact the housing market, including the potential benefits and drawbacks for buyers and sellers, in the next section. And you'll learn how to use this information to your advantage, whether you're a buyer, seller, or investor. The housing market is highly sensitive to changes in interest rates and inflation. If interest rates rise, it could become more expensive to buy a home, which could lead to decreased demand and lower housing prices. For example, if you're considering buying a home in Los Angeles, where the median home price is around $650,000, a 2% increase in interest rates could increase your monthly mortgage payment by $300 to $500. But it's not all bad news. Some areas of the country, like the Midwest, might see increased demand for housing due to lower prices and lower cost of living. For instance, if you're considering moving to Chicago, where the median home price is around $270,000, you might be able to find a good deal on a home. Additionally, a historical comparison can be made to the 1970s, when inflation was high and housing prices skyrocketed. However, this time around, the situation is different, and the impact of inflation on the housing market will be unique. Furthermore, a second-order effect of inflation on the housing market is that it can lead to increased rental prices, as landlords may raise rents to keep up with the rising cost of living. But what about the long-term effects of inflation? Can you still build wealth in this environment? That's what we'll explore in our final section, including a surprising example of how one investor built wealth despite high inflation. While inflation can be challenging, it's not impossible to build wealth in this environment. One strategy is to invest in assets that historically perform well during periods of inflation, such as real estate, commodities, or precious metals. For example, if you had invested $10,000 in real estate last year, it would be worth around $12,000 today. Another strategy is to focus on building multiple income streams, such as starting a side business or investing in dividend-paying stocks. For instance, if you're earning an additional $1,000 per month from a side business, you could use that money to invest in assets that will appreciate in value over time. Additionally, back in 2015, when inflation was around 0.1%, the price of Bitcoin was around $200. Fast forward to today, with inflation at 6.5%, the price of Bitcoin has risen to around $40,000. This demonstrates how inflation can impact the value of certain assets. Moreover, a common misconception is that inflation always leads to decreased purchasing power, but this is not entirely true. In some cases, inflation can lead to increased wages and higher demand for certain goods and services, which can benefit businesses and individuals alike. Furthermore, a second-order effect of inflation is that it can lead to increased investment in industries that are less affected by inflation, such as technology or healthcare. But it's essential to be informed and make smart decisions. That's why I'm here to help. In conclusion, inflation is a significant threat to your purchasing power, but there are strategies to mitigate its effects. Remember to stay informed, make smart decisions, and consider investing in assets that historically perform well during periods of inflation. To take action, start by reviewing your budget and identifying areas where you can cut back on unnecessary expenses. Then, consider investing in a diversified portfolio of assets, such as real estate, commodities, or precious metals. Finally, stay up to date with the latest economic news and trends, and be prepared to adjust your strategy as needed. And as a final step, take the Inflation Protection Challenge. Reduce your expenses by 10% and invest the savings in an asset that historically performs well during periods of inflation. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about inflation, hit subscribe. I break down one of these every week. And if you want to learn more about building wealth in an inflationary environment, check out the link in the description below.